Good afternoon, everyone, and welcome to today's webinar, Tax and Deceased Estates. I'm your host for today, Louisa Canedo, and I am the Tax Manager at State Trustees. Firstly, I'd like to acknowledge the traditional custodians of the land on which we gather today. We extend our respect to Aboriginal and Torres Strait Islander peoples joining us today. So before we start today's session, I would like to thank you all for joining us. It's really great to see so many of you here, ready to learn more about our favourite topic, tax, and of course, planning for your future. So today we will be discussing topics relating specifically to deceased estates and how tax is managed and treated within an estate. The format for today will include a brief background of State Trustees, an introduction to our tax experts on the panel today, some tax topics that we'll run through, and then we'll have a segment for some frequently asked questions as well. And then I'll give a bit of a summary of the webinar and a special offer just for you today. So please stick around. As I mentioned, we will have some time to share some frequently asked questions, including some of yours today. So I do encourage you to type your questions in the chat feature of Zoom throughout the webinar, and we'll do our best to cover them in the segment later in the webinar. Okay, so let's kick off. State Trustees. Who are we? Well, State Trustees is a Victorian government-backed company. We provide financial and legal services to all of Victorians at important moments in their life. State Trustees writes more estate planning documents than any other organisation in Victoria. And because of this, we are experts and we understand the complexities of the laws relating to areas such as wills, deceased estates, power of attorney, and even trusts. In the tax space in particular, we are actually one of the largest tax agents in Victoria. So we have a lot of knowledge and a lot of expertise. State Trustees has been working with Victorians for over 120 years. And in that time, we have prepared thousands of documents. We've truly seen it all and experienced it all. And that's given us a lot of knowledge and a lot of expertise and care as well to provide support necessary to give you peace of mind for the road ahead. So today's webinar is focusing on some information and some tips for you to best manage your tax affairs now. So to make it easier for an executor, administrator, or even a power of attorney down the track. And our aim today is to bring some awareness to you for some issues that you may face in the tax area specifically when it comes to planning for your estate, and to let you know that we're here, we are experts in the field, and we want to help. So now I'm going to introduce you to our panel of experts and speakers for today's webinar. We have Natalie Incratoli, Rahini Prasha, and Gavin Go. Natalie, Rahini, and Gavin are all accountants within the tax team and collectively have been with State Trustees for over 45 years. So there's a lot of experience and knowledge here with you today. So let's get into it. We will start with Natalie, who will be discussing tax and deceased estates.
Thank you, Louisa, and hello to everyone. Today I will be talking to you about what the role of an executor and an administrator is and what assets form part of an estate. I'll then speak about the tax obligations placed on executors, and then I'll provide you with some ideas on what can be done now to assist both executors and beneficiaries in the future. So let's talk a little bit about the role of an executor or administrator. I guess the first question is, what is an executor or an administrator? Well, basically, these terms are interchangeable and they relate to how someone has been appointed to administer an estate. If a deceased person passed away with a valid will, then they would have nominated a legal personal representative, or LPR for short, to deal with their estate. To be formally authorised to administer an estate, they would then proceed to obtain a grant of probate and would be known as the executor. However, if an individual passes away without a valid will, then the person or firm administering the estate would need to obtain letters of administration and would be known as administrator. Executors have an important role as they are stepping into the shoes of a deceased person and winding up all of their affairs. They have a fiduciary responsibility to ensure that the estate is administered in the best interest of all the beneficiaries. The steps involved in administering someone's estate can be broken up into 6 parts. So the first one is applying for that grant of representation, which is either the grant of probate or letters of administration that we have just spoken about. Preserving the assets of an estate, for instance, obtaining insurance for assets such as a car or a property. Identifying and gathering all assets and liabilities. Defending a claim of action on behalf of the estate. Attending to the income tax affairs, which I'll cover in a bit more detail in a moment. And once all the above tasks have been completed, distributing the estate to the beneficiaries. Really important that executors have an accounting for all records and tasks that they have undertaken for an estate. This is required as part of fulfilling their fiduciary obligations, as they could be held personally responsible if they have not done this. Let's now talk a little bit about what assets form part of an estate. What assets would be an executor be responsible to manage? Well, some examples of assets that form part of an estate include solely held assets, such as a bank account or shares that are just in one name. Property, if the deceased ownership interest is held either solely or as tenants in common. And Rohini will talk a bit about this shortly. Superannuation, which Gavin will speak a little bit more in detail down the track. Foreign held assets, so for tax purposes, worldwide income is taxed, which would include income from foreign assets such as bank accounts, property or shares. And personal effects such as jewellery, cars and collectibles. Some assets that don't form part of the estate include jointly held assets, as the asset would automatically transfer to the surviving owner, which is quite common between spouses with joint bank accounts or property. Also, superannuation may not form part of the estate if it is paid directly to the beneficiary. Now that we have an understanding of what assets form part of an estate, what responsibilities do executors have in relation to the tax affairs of a deceased person? Well, it's the executor's responsibility to review the income tax affairs and attend to any outstanding tax obligations for a deceased individual. This includes GST obligations if the deceased had been operating a business and was registered for GST. This responsibility extends to not only lodging any outstanding tax returns, but also reviewing previously lodged returns to ensure that they are correct and have disclosed all of the necessary information. The first task to be completed is to review the deceased's individual affairs and lodge all outstanding tax returns, which includes the final return. This can sometimes be referred to as the date of death tax return. The final tax return covers the period between the start of the financial year up until the deceased's death. Any income earned in this period, which could be from salary and wages, pensions such as Centrelink, Department of Veteran Affairs or foreign bodies, superannuation income streams, income from assets such as shares or an investment property that were held both solely or by jointly with another partner, or even business income if the deceased person was running a business, would all need to be included in this final tax return. Along with reviewing the tax affairs of a deceased person, executors also need to officially advise the ATO of the deceased's passing by completing a deceased person notification form and providing the grant of representation to the ATO. This is so that the ATO can formally update their records that a taxpayer has passed away and also notes the authorised executor's details. Once the tax affairs of a deceased individual have been completed, it's then time to attend to the income tax matters of an estate. So it's a common misconception that when someone passes away, that there may not be a need to pay tax anymore. But unfortunately, that may not be the case if the estate receives any income. The first estate period commences the day after someone passes away until 30 June of that same year. From then on, the income tax affairs of an estate are based on the full financial year up until the time the estate has been fully distributed to the beneficiaries. The estate may earn income from assets held by the estate, such as bank interest, superannuation death benefits if the funds from super are paid to the estate, income from dividends or investments held prior to their disposal, and the big one, the possible capital gain or capital loss from the sale of any CGT assets of the estate, such as shares or property. The executor will need to apply for an estate tax file number if either an estate tax return is required to be lodged or if an interest earning bank account has been opened for the estate. The estate tax file number should be given to the banks if this is the case to prevent any resident withholding tax being taken on any bank interest that has been earned. The ATO has placed greater accountability on executors surrounding the tax affairs of a deceased person and their estate, and it's therefore really important to address the tax affairs of someone thoroughly, as executors can be held personally liable by the ATO should the estate be distributed to the beneficiaries and a tax obligation or debt has not been addressed or attended to. So, what are some things you can do now that might help executors or beneficiaries or even family members in future? First and foremost, consider completing a will, or if you have completed a will, review it to make sure it correctly represents your wishes. Remember, a will is the final chance you will have in expressing your wishes on who you would like to inherit your estate. In our experience, we've seen many examples of estates where wills have been written a number of years ago but haven't been reviewed or updated. Because of this, people such as an ex-spouse or an ex-friend have received an entitlement of the estate as those were the instructions in the will. So it's always a good idea to review your current will when things change or write one if you have not yet done so. When reviewing your will or writing a new one, it's also a great time to review the assets you own and determine what the tax implications might be should that asset either be sold in your estate or transferred to your beneficiaries. Could those assets have tax or even Centrelink implications for your beneficiaries? You may want to consider speaking to a tax advisor as well as a financial advisor who might be able to help you determine what those implications are. The next tip we have is that if you're a little behind with your tax affairs, now is a great opportunity to try and get on top of them. We understand that tax can be quite a daunting process. However, bringing all of your affairs up to date now will prevent any delays and additional costs in future to your estate. And if you need any help with attending to your tax matters, you can always reach out to us as we might be able to assist you with this. The last tip we have is to consider utilising any capital losses you may have by selling CGT assets that may result in a capital gain now. If an individual has any capital losses at the time of their passing, unfortunately, these can't be carried forward to the estate, and therefore they're lost once you pass away. If you think that this might be a good option for you to explore, it is highly recommended that you speak to a financial advisor to determine if this is a suitable strategy for you. Speaking of delays, in our experience, we find that most delays in attending to a deceased individual or estate's tax matters are due to documents or records not being readily available and having to be requested from third parties. Sometimes not only can this be time consuming, but it can actually be costly as third parties can often charge a fee to provide records should they need to go back through their archives to retrieve it. Some examples of information that might be really helpful to an executor or a beneficiary or your family members in future include your personal tax file number, paperwork such as purchase documents or records for your assets. An example we come across quite frequently these days is investors with cryptocurrency. If executors don't know which platform the deceased held crypto with, then these assets might be lost as you can't redeem them. Relationships with all beneficiaries. So not just documenting the beneficiary's relationship to you, but also their full name and contact details. This would really assist your executor as from time to time people move and you could lose touch with them. It would be your executor's responsibility to locate these beneficiaries and be costly if genealogists need to be engaged to find them. It's therefore always a great idea to keep up-to-date information with your will for your beneficiaries. Residency and which country is your tax residence is another quite common issue that we come across. If you're one of these people that spend 6 months in Europe over their summer, and then you come back to Australia to enjoy the Australian sun for the next 6 months, apart from me being extremely jealous of you, there could actually be tax implications which can create an issue for your executor down the track. And that could be around which country is your residence for tax purposes. If there's no documents available to verify which country is your chosen country of residence, your executor can have a real tough time of trying to establish that. Similarly, if you have more than one property and have lived in both properties, it can also be a little tricky to identify which property is your main residence. To help, any documents or notes that express your wishes to treat which property as your main residence can really be of assistance in future. If you do all of this, then that's brilliant. But the other most helpful thing is to also let your executor know, or your family members know, where that documentation is and can be found. In our experience, when family members decide to clean out a property, they may not realise your important documentation is located there and accidentally throw it all out. So letting your executor know where they can find that information is really helpful. Thanks so much for your time, and I'll pass you back to Louisa.
Thank you, Natalie. Some really good insight there, some good tips. All right, next is Rahini, who will be discussing property, capital gains tax, and deceased estates.
Thank you, Louisa. Again, a very warm welcome to everyone attending today. My name is Rohini, and I will be presenting on properties and tax implications. As we get older, many of us think about downsizing, moving closer to family, or planning how our properties will be passed on. It is important to understand how the Australian tax system treats your property, especially the rules about main residence and related exemptions. On a high level, I'm going to cover the following. Main residence. What happens with your main residence when it forms parts of your estate? Survivorship versus tenants in common. And finally, if you hold more than one property at one time. The first one I will be looking at is the main residence, which can be one of your biggest assets. So, what is your main residence? In a simple terms, your main residence is the home that you treat as your primary residence. In most cases, you don't pay any capital gains tax when you sell your main residence. To qualify for the main residence exemption, the property must be your primary residence since the date of purchase. It must be on a land under 2 hectares. And thirdly, it's not used to produce income. For example, it could be rented, or you could be running a business from the property. If you have acquired your property prior to 20th September 1985, that is when the capital gains were introduced in Australia, and we call it a pre-CGT in tax language, then you have a luxury to simply disregard the capital gains tax on the sale of the property. This is irrespective of how you use it, whether you live in it, rent it, or run a business from it. The capital gains on a pre-CGT property will be disregarded. However, if you have purchased your property after 20th September 1985, then the above conditions that I mentioned must be fulfilled to get the main residence exemption. If you decide to move out of the property and leave it vacant, or if you decide to rent the property, then special rules may apply. So now I'm going to look at the main residence when it forms part of the estate. If at the time of the death, the property was the main residence, the special rules will apply. If the property is sold and settled within the 2 years of date of death, the capital gain will be disregarded in full. If the property is sold and settled outside the 2 years time frame, the executors or the beneficiaries can apply for an extension by a private binding ruling to the tax office if they have a valid grounds. If the private ruling application is successful, then any capital gains on the sale of the property will be disregarded in full. If unsuccessful, then the capital gains will need to be assessable in the year of sale. I hope this will help you and your families to plan to avoid unexpected tax consequences. Now, let's look at the type of ownership of assets. Generally, there are two types of ownerships. The first one, joint ownership, and the second is tenants in common. So what's the difference between the two? With the joint ownership, each joint member equally owns an interest in the property. For example, your property held jointly with another person would suggest 50-50 ownership. In regards to tenants in common, ownership can be equal or unequal in the property. Perfect example is one party holding 70% ownership in the property and the other party holding 30%. Now let's take a look at tax implications for a property held jointly and tenants in common when one co-owner has passed away. Firstly, let's look at survivorship through joint ownership. When one joint owner passes away, their ownership in that property will transfer to the surviving joint owner. Therefore, the surviving joint owner now holds 100% ownership interest in the property. There is no capital gains tax event at the death of the joint owner, as well as the date of the transfer of the surviving owner. The surviving owner will inherit the deceased ownership interest with either the original cost base or the market value at the date of death. This will depend on whether the property was the deceased's main residence or an investment property. Please note that the property will not form part of the deceased estate. Now let's look at the co-owner's interest held as tenants in common. When a co-owner passes away, their ownership interest in the property will form part of the deceased estate. If their ownership interest is transferred to the beneficiary, the capital gains tax event will be deferred until the beneficiary sells their ownership interest. If, however, the ownership interest in the property is sold by the executor during the estate administration, the capital gains or capital loss will need to be disclosed in the estate's income tax return in the year of sale. So, what happens if you have ownership interest in multiple properties, which is quite common these days? As previously mentioned, you can only claim main residence exemption from capital gains for only one property at a given time. You or your executor can choose which property you want to be treated as your main residence, provided that you satisfy the main residence conditions. All other properties, even if remain vacant or occupied by the family member, will be subject to capital gains tax. So to summarize what I have covered today, generally your main residence is exempt from capital gains if sold and settled when you're alive. If sold in an estate, it must be sold and settled within 2 years of date of death. All additional properties held will be taxable under capital gains tax provisions. If you have any specific complex property arrangements or you need to get an advice, we offer property tax advice as well as cost-based analysis to help you or any executor with tax implications of property matters. So that's it from me today. Handing back to Louisa. Thank you.
Thank you, Rohini. I think it's fair to say that's quite a complex area. That's a high level sort of coverage of that, but we can delve into personal circumstances through contacting us as well. So our final speaker for today is Gavin, who will be discussing asset cost-based reconstructions, followed by superannuation in deceased estates.
Thank you, Lisa. Next, we are going to talk about asset cost-based reconstructions. These terms might sound a bit technical, but I will break it down simply, so by the end, you will know what a cost base is, what goes into it, and why it's worth getting it right, especially if you are thinking about selling an investment property, shares, or other assets. So first, what is a cost base? Your cost base is essentially the total amount you have spent to acquire, hold, and improve an asset. A cost base is used to calculate your capital gain or capital loss when you sell or dispose of an asset. Therefore, if you get your cost base wrong, it can have a big implication on your tax outcome. With that in mind, let's look at what makes up a cost base. On the screen, there are a few main items that we have listed there, and they can include the purchase price. Simply, this is what you have originally paid for the asset. It can also include incidental costs, things like stamp duty, legal fees, brokerage fees, and variation costs. Next, we have ownership costs. This could include expenses you have paid while owning the asset, such as council rates, water rates, land tax, etc. in the context of a property. Capital improvements can also be included in cost base. For example, renovations, extensions, or upgrades that add value. Finally, we also have costs of disposing of the asset, such as agents' commissions or advertising fees when you sell the asset. So you can think of it as everything you have put in to acquire and improve the asset, minus any deductions that you may have already claimed in your tax return. Now, why bother doing an asset cost-based reconstruction? There are three big reasons. The first one being for accuracy for tax. Simply, nobody wants to overpay capital gains tax because of missing information. We do asset cost-based reconstruction also for the peace of mind for future transactions. As Natalia mentioned earlier, having the cost base properly documented helps your accountant, executor, or beneficiaries later on. Finally, is for the compliance purpose. The tax office expects you to have evidence to support your cost-based calculations. This is especially important for long-held assets. For example, an investment property bought decades ago where the original documents might be lost or unclear. In this situation, a proper reconstructions ensure your cost base reflects the real investment you made in that asset. Next, let's talk about record keeping. The tax office requires you to keep records for at least 5 years from the date you lodge your tax return. For long-term investments, it's actually best to keep records for the entire ownership period, including things like contracts of purchase and sale, invoices for legal, valuation, or improvement costs, receipts for renovations or capital works, and even for bank statements showing payments. If you have lost records, a reconstruction is not only allowed, it's actually encouraged. You can use secondary evidence, like council records, historical bank statements, or archived property data to piece together a reasonable and supportable cost base. So in summary, an asset cost-based reconstruction isn't just an administrative task. It's a way to protect yourself and your beneficiaries from paying unnecessary tax. All right, now let's shift gears and talk about another important topic, superannuation and deceased estates. This area often causes confusions. So today we'll go through the basics, including binding death benefit nominations, where tax is paid, and who count as a dependent for tax purpose. First up, binding death benefit nominations. A binding nomination lets you tell your super fund exactly who should receive your super balance when you pass away. If you have a binding nomination in place, the trustee of your super fund must follow it, as long as it's valid. Without a valid binding nomination, the trustee of the super fund may decide who receives your super, usually based on the fund's rules or your estate, which can cause delays or even disputes. Therefore, we have two tips here. The first one being, make sure your nomination is up to date. They often expire every 3 years. Secondly, only certain people can be nominated. This may include your spouse, children, a person who is financially dependent on you, or your legal personal representative. So keeping this up to date is key to ensuring your super ends up where you intended. Next, let's look at where tax is paid when super is paid out after death. This can get a bit technical, but here's a simple version. Tax can be paid inside a super fund or by the beneficiary, depending on who received the payment. If the super is paid to a tax dependent, it's generally tax-free. However, if it's paid to a non-dependent, some tax may apply, typically up to 15% on the taxable component. It is important to get advice here because structuring who receives your super can have a big impact on the total tax paid. Finally, who counts as a dependent for tax purpose? The main categories are your spouse or de facto partner, your children under 18, any person financially dependent on you, or someone in an independency relationship, meaning you live together and provide mutual support, whether financial or emotional. Please be mindful, adult children who are independent, for example, are not considered dependents for tax purpose, which means they may need to pay tax on any super death benefit they receive. Thanks so much for listening. I hope today's session helps make these topics a little clearer. Back to you, Louisa.
Thank you, Gavin, for that overview. Okay, we've now come to the frequently asked questions segment of the webinar. We've got quite a few questions in the chat, which we'll try to answer some as we go along. Firstly, where should all the information be kept for future executors?
Yeah, I can take that one. So really good question. Best to keep it somewhere where people can actually access it. So for instance, some people might have a safe at home or a safety deposit box where you can pop all that information in. If you have a tax advisor or a financial advisor, you might also trust them to hold on to certain records as well. So that, but to let your executor know that that's your accountant or financial advisor so they can get that information down the track.
Thanks, Natalie. Okay, we have another one. What happens when leaving a residential property to adult children? Is there a period that they can sell the house and avoid CGT? I think Rahini actually covered this one, but I'll throw it to you again, Rahini, if you just want to go back over your information.
Thank you. That's a good question. Yes, the 2-year rules will still apply once the deceased passes away and you're leaving the property for your adult children. The ownership interest is determined on the transfer of the legal title. But in simple terms, I can explain that if the property originally purchased was a pre-CGT, even the beneficiaries, if they are selling and settling the property within the 2 years, the CGT can still be disregarded. However, if the asset is the post-CGT asset or purchased after the 20th September 1985 and passes to the beneficiaries, then the CGT event is deferred until they do anything with that property, like selling the property further down the lane. But it's quite technical, so we would prefer that in that instance that you do get the tax advice from the professional.
Thanks, Rahini. Okay, can I include super in my will?
Thank you, Lisa. I might take that questions. Superannuation is actually held in a separate trust, so it doesn't automatically form part of your estate. To include it, you must either nominate your estate as the beneficiary so it can be distributed according to your will, or provide your super fund with a binding death benefit nomination specifying your beneficiaries.
Thanks, Gavin. In my will, I have nominated a friend to administer my estate. Can they utilise state trustees to attend to just the tax matters of the estate?
I will take this one. So yes, absolutely. At STL, we're happy to assist you with the tax obligations if you have appointed an executor of your choice. We have assisted many executors to finalize tax matters with the tax office while they deal with other asset and estate tax administration themselves. So we can definitely help you with that. Back to you.
Thanks, Rahini. Okay. In deceased estates, what if the property owner in a relationship passes away and there was no joint owner or tenants in common set up?
Yeah, I can take this one. Great question. So in that regard, if the property is held solely by the deceased, then that asset would actually form part of the estate of that deceased individual and would be administered in accordance with the deceased's wishes in their will. So if that happens to be a situation that you find yourselves in, it's probably a really good idea to maybe seek some advice, maybe in terms of how your will is written, or if you're planning to write a will, to make it, tax effective down the track.
Thanks, Natalie. Okay, we have time for one more. Can state trustees attend to my personal tax return?
I'll take that one, Louisa. The answer is yes, absolutely. We would be more than happy to attend to your personal tax affairs. As mentioned earlier by Louisa, our tax team specializes in individual tax compliance. We would like to ensure your tax return is prepared accurately, efficiently, and in full accordance with the tax office requirements. We actually take pride in helping our clients not only meet their obligations, but also understand their tax positions clearly.